Thanks, everybody. How's everybody doing? Good? All right. It's my great pleasure to be here, and thanks so much to George and the whole Ivy team for having me and for bringing all of us together at what so far has already been a great conference. So what I wanted to talk about today is why Benjamin Graham still matters. We've already heard a lot about, is value investing dead? And of course, nobody here really believes that. But a lot of your clients do. A lot of analysts and investors do. And I think it's important to tap into Graham as an original source and as a living source for insight into that question. So here's the challenge I faced. So Graham was born in 1894. If he were still alive today, he'd be 130 years old. The Intelligent Investor was first published 75 years ago. And of course, Security Analysis was first published in 1934, 90 years ago. So a 75-year-old book, a person born in the 19th century, should guide us today as investors. There's a lot of skepticism about that. But when we learn more about Graham as a person, we can appreciate why his message is not just relevant today, not just enduring, but I believe permanent. It will never go out of style completely. So how was Graham brilliant? Well, let us count the ways. First, he was just plain intellectually brilliant. He was a student, a scholar, a teacher, an inventor, and an author. So Graham was admitted to Columbia, my alma mater, when he was 16 years old, but that was only because the Columbia admissions office had bungled his paperwork, because he was supposed to have been accepted when he was 15. He graduated second in his class in 2.5 years, after working full-time for almost a year at night to support his widowed mother. There may be someone in this room who graduated college in 2.5 years. Anybody put your hand up? Were you salutatorian of your college class? Did you spend the better part of a year working all night in order to support your mother and still accomplished all that? And before Graham graduated, late in his senior year, his 4th year of college, Columbia offered him professorships in 3 different departments at once: Greek and Latin philosophy, English, and mathematics. And if that isn't a Renaissance man, I don't know what a Renaissance man is. Graham also held 2 US patents on what I guess we could best describe as manual pocket calculators or slide rules. And of course, he was a brilliant author, not just of 2 of the foundational investment books of all time, but also late in his life, he decided it would be fun to learn Spanish, so he taught himself Spanish and translated a Uruguayan novel into English for fun. And he also played Scrabble simultaneously in English, French, and Greek, George. I guess he had special Scrabble chips for that. But in any case, Graham was, of course, an incredibly brilliant investor, and his achievements as an investor are really underrated because they're misunderstood. So during his career as a professional investor with a measurable track record, which was when he was running the Graham-Newman Fund, it was a 20-year period. The S&P was up about 12.1%. The fund was up 17.4%. And as Buffett told me when I asked him, do you have any additional information on this? He said, oh, his performance was far more terrific than that. Because, of course, as many of you know, at the end of Graham-Newman's time as a standalone fund, or toward the end, I should say, it spun off Geico. And investors in the fund who took that special dividend and held on to it not only earned the returns from Graham-Newman, but also the returns of Geico, which were huge up until the 70s. And above all, Graham was an incredibly insightful psychologist. He invented the metaphor of Mr. Market, which I imagine most of you in the room are familiar with. We'll talk about it more in a bit. Graham appreciated that the job of anybody who advises clients or serves clients is not to impose the optimal solution, but to implement an achievable solution. What people can do and what people should do and what they can do are two very different things. So Graham often in his books talked about strategies and techniques that are suboptimal, but which he felt convinced people could actually follow. And then, of course, there's the wonderful expression that Buffett often cites and that I hope some people in the room have memorized: you're neither right nor wrong because the crowd disagrees with you. You're right because your data and your reasoning are right. And Graham also has a wonderful line, I think it's in chapter 15 of The Intelligent Investor, where he talks about speculative behavior. And he says, the investing public is incorrigible. I think he says the speculative public is incorrigible. In financial terms, it cannot count beyond 3. And when I researched my book on neuroeconomics in 2007, I was fascinated to discover that neuroscientists have demonstrated that after 2 repetitions of a stimulus, the human brain automatically expects a 3rd repetition. So I think Graham intuitively sensed that that was part of human behavior long before scientists ever proved it. So those were all the reasons why Graham is great, and it's tragic that he's remembered as somebody completely different. This is sort of the caricature of Graham that so many growth investors and people who aren't fully familiar with his legacy have characterized him. You know, this is, I'm sure a lot of you in the room know this formula, right? And Graham understood perfectly that this formula it's kind of nonsense, right? And the reason it's nonsense is that one word, expected. So, of course, the higher the growth rate, the higher the expectations for the growth rate in the future. You know, as Sam alluded to in her presentation. And the higher the expectation goes, the wider the fan of uncertainty around the high end and the low end will become, until the expectation is absurd. And so Graham says, okay, you want to multiply that thing by 8.5 plus 2x? Go ahead. It's not going to work. But it's a rule of thumb that has become associated with Graham. And that's really unfortunate. So, here are other formulas that are associated with Graham, right? If you're a defensive investor, you should look for a product of PE and price to book no higher than 22.5. I mean, good luck finding that in today's markets. I mean, it exists here and there. There's probably a few handfuls of stocks in the US market that meet that description. And then, of course, he talked about net nets, where you want to try to find equities that trade at less than 2/3 of working capital. And then, he had these other measures as well. This is all not what Graham stood for. It's just shorthand, which often has been wielded frankly, by the enemies of value investing to use as a criticism, to say, this discipline is rigid, inflexible, obsolete, these measures are ridiculous. And Graham would be the first to agree, because he wasn't about formulas. He wasn't about rigid, simple little mathematical equations. He was far more sophisticated than that. And when you read The Intelligent Investor, what you should be looking for is the way Graham concentrates on first principles. That's what this incredibly brilliant man trained in Greek and Latin philosophy wants us to think about. The same way Plato coached his students to define all your terms, to think about what you're trying to accomplish. What are your objectives? Where do you want to come out? And that's what Graham is important for. So, I won't dwell on these. I'll just run through them quickly. Everyone in this room knows that stock is more than a ticker symbol. It's a business. And we'll talk about Mr. Market more in a minute. The margin of safety, which is so important. But one thing that is so underemphasized about Graham is, if you want to succeed, you have to organize for success. You can't just value stocks and run a portfolio unless you design your business from the ground up to be able to be an active manager, to be able to bring your clients along with you. So, who is Mr. Market? Is this Mr. Market? You remember this guy? Meme stock man from 2021? Yeah, some of the time that's Mr. Market. Mr. Market can be pretty crazy. Graham knew that. We all in this room know that. David talked about this, and Ajit talked about this. The market gets pretty crazy sometimes, right? So, you remember Chad? Anybody remember Chad and Jenny from 2021? This crazy couple on TikTok. So I won't play the video, but what he said was, I see a stock going up, and I buy it, and I just watch it until it stops going up, and then I sell it. And I do that over and over, and it pays for our whole lifestyle. And I assume he's like an Uber driver now, but supposedly he was making $20,000 a month doing this for some brief period in 2021, right? So yeah, he was Mr. Market for 15 minutes of investing time. But I'm going to argue that's not who Mr. Market is. Graham said most of the time his idea of value appears plausible and justified. And yeah, Mr. Market's moody, but he's not a moron. He's just not, especially over time and after cost. I think you should all think of Mr. Market as if he were an ETF competing with you. So what does that mean? It means Mr. Market isn't impatient. He's patient. You know, an ETF like IVV or VTI, ETFs that follow the S&P 500 or the total US stock market, they barely trade at all. If their turnover is 5% in a year, that's a big deal. You're competing against a form of Mr. Market who holds his average stock for 20 years at incredibly low cost, 3 basis points, which is on its way to 2 and then 1, and incredibly tax efficient. So Mr. Market is an ETF and you're not. That's the principle from which I think you have to proceed as a value investor. And that dictates how you have to structure your firm and your approach. So Charlie Ellis wrote one of the foundational articles in investment management, The Loser's Game, in 1975. I hope a bunch of people in the room have read it. Hands up. The Loser's Game by Charlie Ellis. So, you know, that great article is famous for his image of investing as a tennis match, right? Where the match will be won by whoever makes the fewest errors, not by whoever scores the most points, right? But I think it should be famous for 2 reasons. That's one. But the second is this very simple algebraic formula that Charlie spells out. And it doesn't work in a screenshot, so I had to turn it to text. But of the portfolio managers in the room, whether you run a mutual fund or an SMA, or whether you're in a hedge fund format, if you took your expenses as the equivalent of a mutual fund, how many have expenses under 75 basis points a year? Okay, so I picked a good number. Let's assume your expense ratio is only 75 basis points. Let's assume your average annual portfolio turnover rate is 50%. Your holding period is roughly 2 years on average. And let's assume you can trade pretty cheaply. Costs you 50 basis points to trade a stock, counting commissions, spreads, all the implementation costs. This is Charlie's formula. So let's assume generously that equities are going to return compound at 10% a year. And all you want to do is you want to do 10% better than that. The market does 10%, you want to earn 11 net. You want to deliver 11% to your clients. So Charlie says, that's your net return. What does your gross return have to be? You have to beat the market by 225 basis points a year before expenses to come out 100 basis points a year ahead after expenses. And that's if the market returns 10% a year. The lower the market rate of return goes, the higher the margin of your outperformance has to be in order for you to hit your objective. So, how did Graham go about structuring and thinking about the business so that he could achieve great results? So the first thing to think about is this wonderful quote from the business historian Alfred Chandler. Unless structure follows strategy, inefficiency results. And this is based on his study of hundreds of the world's greatest corporations over the course of decades. And my take on the way the investment management business conventionally works is it's not that structure follows strategy, it's that strategy follows structure. So you organize as a conventional mutual fund, well, you're going to be under a lot of pressure to own at least 100 names. They're all going to come from the index that you track. Your prime directive will become minimizing tracking error and staying in your style box and never surprising your clients and never disappointing them by too much. And the result is you're going to have a very boring, homogeneous, undistinctive portfolio with a big expense ratio and a portfolio turnover rate that's too high. So what did Graham do? What did Graham do? He benchmarked his performance, but he didn't benchmark his portfolio. And what do I mean by that? Graham was one of the first professional money managers in the United States to benchmark himself to the S&P. Everybody else either used no benchmark at all, because it wasn't required by SEC rules at the time, or they used the Dow, which of course is I work for Dow Jones, but it's a crappy index, right? Graham used the S&P. Why? Because that was the fair way to measure his performance. But he didn't assemble a portfolio that looked like the S&P 500, and wait till you see what his portfolio looked like. So at his firm, Graham Newman Corp., how did he structure it? So it was an open-end mutual fund. It was registered under the 1940 Investment Company Act. But he shut it down. It was permanently closed to new investors after a few years. So what does that do? I'm interested. Anybody in the audience have thoughts on why that might matter, why that would be a good thing from the point of view of the clients? All right, everybody's shy. Dave. Too much capital is the enemy of outperformance. Exactly. So that's true on two dimensions, right? It's true in terms of levels, and it's true in terms of flows. And we'll talk about that in a minute. So Graham kept the assets at his fund incredibly small. In 1955, after 20 years of outperformance, the fund only had $6 million in it. And if you define today's dollars very generously, that's about the equivalent of 200 million in 2024 dollars. So a really tiny fund. Graham not only kept the fund small, but he made sure that nobody would want to buy it. He did a 10-for-1 reverse stock split to drive the share price over $1,000 to repel people. He was like, I don't want your money. I don't want to deal with you. I just want to run a portfolio. It's incredible. To the best of my knowledge, there's no comparable example of that in asset management, except, who do you think I'm thinking of? Berkshire Hathaway. Where do you think that idea came from? So the result was Graham had this fanatically devoted client base. And the result of all of these things is that he took that gargantuan gap between how a fund performs and how the owners of the fund perform, and he just squashed it. So somebody, I think, was it you, Sam, who mentioned Cathie Wood? I mean, think about the ARC funds, right? So there was a 3-year period of gigantic outperformance, 50-year compound returns. Performance before that was okay. Performance after that was disastrous. How did the average investor in the ARC fund do? they lost their shirts in a fund that had arguably one of the best 3-year track records in history. And Graham did the opposite. So normally cash flows to and from investors are pro-cyclical, right? When the market is hot, people throw money at you. When the market goes cold, they yank it all back. Graham was like, that's not happening here, folks. We don't have cash flows at Graham Newman. We just have investors. And the result of all this is he could do whatever he wanted. And he did. So where do you think Buffett learned how to be flexible? I mean, Sam talked about how, Buffett started out buying cigar butts, right? The same way Graham did. And then he moved to special situations, and then he started buying private companies outright. And Buffett has always toggled back and forth between the private and the public markets, depending on where the opportunity was greatest. And he learned that from Graham. So in Graham's first incarnation and his second incarnation, he just did a bunch of fundamental analysis on individual securities, stocks and bonds. He owned a lot of, he loved converts. He would buy preferreds sometimes. And lots of special situations, bankruptcies, workouts, merger arb. And he used cash not just as defense, but also as offense. Then there was Graham 3.0, late in his career. So, of course, he always had a personal account. He retired in 1956. He retired, air quotes, in 1956. But then in the 1970s, with a younger friend of his, Jim Ray, he set up another mutual fund. And Ray really ran it, and it wasn't structured the way the Graham Newman Fund was, which is probably one reason it didn't succeed. But it was arguably the first smart beta fund, the first factor fund. Graham said, I'm not analyzing any securities bottom up anymore. I'm just going to buy baskets of funds that are pass my statistical tests, exactly like what AQR or research affiliates or any number of other smart beta or factor firms do today, based on 50 years of back-tested data, not 5, the way most people do it today. And the other thing is, of course, as I alluded to earlier, he was constantly changing his mind based on new information. He had one of the most open minds of anybody who's ever worked in the asset management business. And he also had no self-delusion. Geico was his biggest success, and he broke his rules to buy it, and he admitted late in his life that he probably bought it just because he was lucky. So here's Graham's portfolio policy. So that it's a look at the Graham Newman Fund 3 years apart. And I don't know if you can actually see these numbers, but I got these from Walter Schloss, who died a few years ago, who was one of Graham's students. And so in 1943, the fund was 3% in cash. 3 years later, 11% in cash. In 1943, the fund was 68% in publicly traded equities, 21% 3 years later. Because I don't think anybody in this room was around in 1946, but it was a huge bull market. And instead of going after it, Graham went in the other direction. And he could, because of how he had structured his firm. Here he is talking about capacity and why the fund wanted to stay small. And really the key thing here, this is from his congressional testimony, he said it's not possible to acquire an unlimited amount without affecting the market price. And if we had 10 times as much capital, we wouldn't be able to do as well. So he was very content to have a small asset base. And here he is sort of bragging about how much he charges, and it's kind of quaint, because even if you update it to today's dollars, the amounts are kind of ridiculous. He talks about how his huge salary of $25,000, which is maybe, I don't know, 400,000 or something like that today. But he also got 20% carry after a hurdle. So if Graham were around today, what would he be doing? So would he just be running like a large cap value fund, trying to find relative value and be opportunistic when, some big stock gets trashed because of bad headlines? That's what a lot of value investing consists of, way too much. Graham would do nothing like that. He would recognize that cash flows from and to clients are not just a blessing, they're a curse. Most large asset management firms, at least in the US, and I'm guessing in Canada also, they are organized around the principle of maximizing positive cash flow from retail and institutional clients. They're not organized around the principle of trying to outperform. What they want is they want more money to manage. That's what drives the business. And Graham would have nothing to do with that. The other thing I think Graham would recognize is this is one of my basic rules of survival. Whatever can be an ETF is going to be an ETF. So you run some value strategy, it's probably already an ETF, and it's competing with you already. And it's very difficult to come up with so differentiated a strategy that someone can't turn it into an ETF. So what can't be ETF'd? There's a few things, right? Some of them are kind of obvious. You want to be on the left tail of a bunch of distributions, right? You want to be on the left tail of size. You want to be on the left tail of liquidity, because ETFs can't trade, they cannot trade stocks that don't trade. You want stocks that aren't very marketable, and you want stocks that aren't very popular. Securities that aren't popular. They don't have to be equities, obviously. Microcaps, obvious example. There's a couple of microcap ETFs, but it doesn't work very well in an ETF because the benchmarks are the benchmarks differ. Why? There's huge dispersion in the benchmarks. That's what I'm trying to say. And it's difficult for ETFs to be in the microcap arena without getting crushed by some other benchmark for microcaps. So, and the transaction costs are huge, and it just doesn't work. So merger arb, another really obvious area. Community banks, maybe, like in the US particularly. Bankruptcies and spin-offs. And of course, maybe everybody's favorite, the stocks that get thrown out of an index. But not just stocks that get demoted from, say, the S&P 500 to the S&P mid-cap index, but stocks that just get thrown out of indexes, period. Those are the true orphan stocks. It's not that they go from being owned by one index fund to being owned by another. They go from being in an index to being nowhere. They're harder to find, but they're out there. And there's no ETF for those. And I don't think there ever will be, because nobody would touch it. So these are a few ideas, but it all flows from that principle about structure and strategy. Instead of trying to force the strategy into a structure that isn't optimized to achieve it, instead, you have to build the structure to make the strategy implementable. And that's what Graham understood. And Graham cared enormously about squeezing that gap between the fund and the people who own the fund. The time-weighted return of the fund might be up here, but if the dollar-weighted return of the people who own the fund is down here, then the fund is a failure because it didn't deliver wealth to the community of people who own it. And Graham understood that. So I saved the surprise for the end. This is the new edition of The Intelligent Investor, which I edited, which will be out in October. And people ask, what did you do that's different? The previous revised edition was in 2003, so what did I do? I took the past 20 years and I put them in there. And of course, a lot has happened in the past 20 years, but arguably it has made Graham more relevant than ever, not less. So I'd love to take some questions. Thank you. Thank you.
Jason, thank you for your wonderful overview of Ben Graham. Reminds me a lot of the beginning of my career in the investment field, working for someone who worked at Graham Newman.
Wow.
You were highlighted in the acknowledgments recently of a book written by Rob Copeland called The Fund. And he makes mention of your incredible career, of the history of finance, etc. If you will, could you, I don't want to upstage your book, which of course we'll all buy, but could you give a bit of a review of The Fund, which provides an overview of the largest hedge fund in the world?
Yeah, okay. So thanks for that, and thanks for the kind words. So Rob Copeland, who wrote the book The Fund about Bridgewater and Ray Dalio, is a friend of mine and a former colleague at the Wall Street Journal. He's a great reporter. I will confess I haven't read the whole book, mainly because I was too busy perpetrating mine. But what I've read, I think, is fair and sounds accurate. I know Rob to be a really tough reporter, but he's also a very fair reporter. And what is interesting to me about Bridgewater and Ray Dalio is what they set out to do and what they appear to have done. So the notion of radical transparency, as I believe Dalio calls it, is kind of amazing. This idea that, every aspect of every decision should be subject to collective review, and that all your colleagues should be analyzing all your conclusions all the time. And I think that's a really interesting idea. The problem is making it work without destroying people, right? And I think there are some firms that have made ideas like that practical, but it's very, very hard. And what the book kind of documents is that, Ralph Wanger, the great manager of the Acorn Fund, has a beautiful expression. He says, on Wall Street, every bad idea starts out as a good idea. And I think that may describe this concept. I think when you take it to an extreme, you just end up terrorizing people and squashing creativity. And that's kind of his argument in the book. And I should add, of course, that Bridgewater disputes almost everything in the book. And time will tell who's right. But anyway, let's take the next question.
Thanks, great presentation. And I want to get your perspective on how Graham would, in today's world with AI and all the abundance of data that is available, how, if at all, he would change his perspective on the thinking of value investing.
Well, of course, I'm only guessing. But my guess would be not much, if at all. First of all, Graham was not a believer in relying on information from management. He didn't really trust corporate management. He never visited the companies he owned unless he took them over because they turned out to be incompetent or dishonest, as Ajit was referring to. He had almost no contact with companies directly. Graham just, he was a fundamental investor, and I think he would, if he were around today, he would be doing pretty much this. He would have a very similar process. He would almost certainly use different filters and criteria, but I think he would proceed from the financial filings, which is how he worked. He just regarded companies as, cash flow machines. And he would look at the financial statements, figure out the cash flows, and make his decision based on that. And I don't think he would take AI into account any more than Buffett and Munger would take it into account today. So that's my guess. Go ahead.
Jason, thank you for the wonderful presentation. James DiCenzo, Dundas, Ontario, Ben Graham, School of Business Conference regular. Thank you, George. One of your associates in the Wall Street Journal, I've been reading the journal for quite a few decades now, Scott Patterson wrote a book called Chaos Kings. And Mr. Spitznagel and Taleb have nothing nice to say about the investment management industry except value investing. But Taleb is adamant there may only ever be one Warren Buffett. And after this great presentation on Mr. Graham and his fund, given Warren Buffett's recent letter to shareholders, what do you think about Warren Buffett's comments on not being able to grow anymore, not being able to replicate the growth they've seen in prior decades?
Yeah, so the first obvious thing to say about that is Warren Buffett has been saying that since 1961. And I'm not kidding. And those of you who have read the partnership letters know that I'm not kidding. He's been saying it for over 60 years every year. So eventually he'll be right. But he hasn't really been right yet. And it's, of course, good to know that there's something that guy is wrong about, Look, $163 billion in cash, that's a lot of cash. That's a lot of cash to move. As he has said over and over again, they're hunting for elephants, right? And the problem with that is when you make a mistake, and let's say for the sake of argument that like Gen Re was a mistake, at least it was for a while. When you make a mistake, you make a big mistake. And that's a problem, especially as Berkshire transitions to a post-Buffett regime at some point. May it be no time soon. But maybe I'll also try to answer what I think was an implicit second question, which is, will there ever be another Warren Buffett? And I think there will be. I think maybe with luck, there's one of them in this room somewhere. Maybe one of those 9 great students, I hope. Although the field is not all male either. Let's keep that in mind. I think I'm confident about one thing. There is no next Warren Buffett in the conventionally organized investment management industry. Warren Buffett became Warren Buffett because because he made his strategy determine his structure. Warren Buffett has had no cash flows, no external cash flows since 1965. Nobody gives him money when the market is hot. Nobody takes it away when the market is cold. The only cash flow he has is float from his insurance companies. So no wonder when you combine brilliant security analysis with that structure, he's been able to do what he did. And Munger did the same thing. Munger had float, and Munger had no cash flow when Munger ran his own partnerships, and when he ran Wesco, and when he ran Daily Journal. That's the key. If you want to be the next Warren Buffett, stop thinking of that as, I need to imitate the way he picks securities. Yeah, you do. That's necessary, but it's not sufficient. You also need to rethink your structure so that your strategy determines the structure, not the other way around. Who's closest to the mic? Yes.
Thank you so much for your insight into Benjamin Graham. I was wondering if you've given any thought as to why he developed a fund that was so investor-friendly. Did you sense that he was being altruistic, or was he a shrewd strategist or marketer? And how would that influence how we look for managers today?
Well, isn't that an interesting question? Again, I can only speculate, but my reading of Graham, particularly his memoirs, suggests to me that he really felt terrible about what happened after the crash of 1929, because he sort of wiped out his clients and himself. And he managed the surviving portfolio without charging any fee at all for years on end, until I want to say 1934 or 5. So he basically went for 4 years with no income from his job. And I think that sort of scarred him. And when he set up his fund with Jerry Newman, he was like, I'm not doing that to people again. And I'm not doing that to my family again. And, one of his family members made an unforgettable remark about Graham as a person. And I think, George, you'll recognize this. I think it was his niece, said he was humane, but he wasn't human. And I kind of love that. There may have been sort of a streak of like Asperger's or, very mild autism in him, the same way some people have seen that in Buffett, for example. But he really valued right and wrong and doing well by people. So even though his personal interactions with people one-on-one could be sort of complicated by that. He really wanted to do the right thing. So, like, if you're picking a manager today, I would say you should, I mean, the typical, so like the 4 Ps, right, that Ajit put up in his presentation, you know, whatever it is, again, people, philosophy, process, and performance, right? So let's not kid ourselves. The only P that anybody ever looks at is performance, right? The other all the other Ps are just like, you know, nobody pays attention to those. But structure is what you should be looking for. And you should be looking for distinct aspects in how the firm is run. Because the performance will come and go, but the structure, if it's well designed and the firm has the staying power to preserve it, the structure is what you're buying. You can't buy future performance, you can only buy past performance. So that's what I would do. I would invert that pyramid. In fact, I would, like performance, you have to look at it, but I would look at it dead last, and I would think about all the other things first. So do we have time for another one? Yeah?
Hi, Jason. Matthew Cullen, Richmond, Virginia. First of all, one comment and one question. First of all, a comment. As someone who owns a bunch of U.S. thrift conversions, your comment on community banks walked me off the ledge for a couple months, so thank you for that. And then my question is, and you sort of hinted to it in your last answer, is I'd love to hear you kind of talk about Ben Graham in the through the lens of your book, Your Money and Your Brain, which I thought was a fantastic book, so thank you. How would those types of behavioral things apply to him? Would he be like, was he aware of those types of same situations? He had some ups and downs. Just kind of how did he deal with those types of things would be greatly appreciated. Thank you.
Yeah, so Graham was, I think, may have been the most psychologically sophisticated portfolio manager we've ever seen, with the possible exception of Buffett and Munger. He understood so well that the only thing that really matters is staying power, right? I mean, one of the key discoveries of modern psychology is how poor people are at forecasting their future states of mind. It's actually called affective forecasting. How well can you forecast, predict your affect, your emotions? People are terrible at it. I mean, assuming you've had more than one relationship in your life, what happened the first time you were jilted, when you got dumped? What did you say? I said, I'll never fall in love again. Was I right? No. Thank goodness, as Sam pointed out, my wife did have low expectations, so it worked out very well. But people are terrible at that. And so all of Graham's advice is really centered on helping people minimize their future regret when the thing they predicted won't really be that important actually comes to pass, and it's terribly important. Like, what's the worst thing investors say? Like, what are those like stupid risk tolerance questionnaires? What's the first question on every single one of those, pardon my French, damn things? The first question is always, if the stock market falls 10% tomorrow, will you buy, sell, or hold? And people, 10%? Of course I'll buy more. You know, and then the stock market goes down 10% and their hair is on fire. Because they can't in a cold state of mind, they can't predict how they'll feel in the heat of the moment. And Graham understood that. And he's really about policies and procedures and rules that you can live by. And that's why the book is so powerful for individual investors, but also for professional investors. Because I'm sorry, professional investors have more money than retail investors. And that's the difference between them. They have more money.
Okay, last question.
Yep, Sam.
Jason, thank you so much for this thought-provoking talk. As someone who just took over a business, there's a lot of relevant things here, and I think one of the things that's always struck me, people talk a lot about fees and how they hurt investor returns and the benefits of ETFs. And of course that's true, that's how active managers can outperform net on a gross basis, but underperform on a net basis. But what's always struck me is how the end investor is hurt more by the timing, if you look at the magnitude of the hits. And so, we've thought, how can we improve that and try to write and give people data? But I guess as an owner of the firm, you gave some ideas about how you can solve the problem of people buying too high. If you can easily solve that problem if you close
Yes.
a fund, which everyone could do. But I guess the other side is, do you have any ideas about structures where, because the other side of the problem is selling low, which is another big problem. Is there a way to manage retail money and help people not make, I don't know how you stop that. Do you have any ideas?
Yeah, I have a couple, and how effective they'll be is hard to say. So the first, of course, is you can put in like a, what people call a contingent sales charge, right? Which is, or a redemption fee. Like if you own the fund for less than a year, we'll charge you, whatever, 1%, 2%, 3%, wherever you care to set it. And that's good because then people know going in that they've committed to a holding period, right? The other thing you can do is, and Vanguard already does this, and nobody has copied it, and I don't know why, is you can give people a fee discount for sticking around. So you can say, if you hold the fund for 1 year or more, we'll cut your management fee by 5 basis points or whatever it might be. 2 years or more, we'll cut it by 10. And those are just examples. Obviously, you could set that wherever you wish. Now, Vanguard has made that work. Nobody else has copied it. I don't know why. Maybe because other firms have observed that the money's kind of sticky anyway, so why should we give up our fee if we don't really have to? But I would think by doing that, with each passing year, you would be upgrading the intellectual and emotional quality of your shareholder base, which is something Buffett talks about all the time. Because the people who appreciate that you're doing that are the people you want to have there when times get tough. And like when 2008 happens again, those would be people you could pick up the phone and call and say, more capital? And they might say, yeah. But the people who will bail out on you in 2008, you don't want to select for them. You want them to leave. So, those are two ideas, but, I'm sure there's some others that could help as well. All right, thank you. Thanks, guys.